Here we are. It's after the election. Now, what is going to happen to the real estate markets across the country? Real estate itself, home values, interest rates. So let's break that down today. As a veteran and military families, you may be considering buying a home, refinancing, or understanding your options for the future. Our goal today is to connect the dots between bond yields, mortgage rates, and the potential impact of the new presidential term. So let's dive into it. And as a side note, a lot of people have been saying that if certain candidates win, then they're going to be moving out of the country somewhere else. So there could be some hidden potential for buyers to purchase properties. But I think that's a little bit tough because people that have really low interest rates, it's kind of hard to leave that. So first, let's clarify what we mean by bond yields. When we talk about the bond yields, we're discussing the annual return an investor makes by holding a bond until its maturity. It's essentially the income the investor gets for buying debt, aka a bond. So why are bond yields important to us as veterans interested in home ownership? Bond yields are the benchmark of the economy's health and significantly affect mortgage rates. Higher bond yields means higher mortgage rates. U.S. Treasury bonds are commonly watched because they seem as a very safe investment. That is the government's debt. They have maturity dates ranging from a few months to 30 years. The ones that are most directly affecting mortgage rates are the 30-year Treasury bonds. And this is why it's so important to be able to track that, because a lot of people today, and we talk to them all the time, think that, rates have gone down because, the Fed funds rates has dropped. They're not directly correlated. So you need to keep that in mind as you're going through that home journey. Remember, for the most part, the supply and demand is what's going to be driving housing prices. When we're looking at the mortgage industry, you're going to be looking at the 10-year Treasury yield because that's the major thing that investors are looking for. So for example, if you have a 10-year Treasury goes from 3 to 4%, mortgage rates will often follow that trend upwards. And historically, when you look at the correlation between the Fed funds rate and the stock market, the lower the Fed funds rate is, the better the stock market does. So people pull money out of the bond market into the stock market to make more money. Now, I'm going to touch on what happened back a couple years ago, because that's the mindset people have right now that, if the Fed funds rate is dropping, then all of a sudden rates are going to be going down significantly. So the government does have some tools in its tool bag, and it's primarily around monetary easing, okay? What they did back in 21 is they implemented a purchase program of bonds. So basically, they were gobbling up, I think I read somewhere the other day, it's like $60 billion a month in bonds. So yes, can they bring that back when the new administration comes into play? Yes, but remember, it's tax dollars that are being used to purchase these bonds. And that's when they went to go sell them. That's when you also had a large acceleration in mortgage rates. So kind of keep all that in mind because it correlates. So just really depending on how it's structured. And so when stocks markets are doing well, investors sometimes shift that money out of bonds into stocks. And that's, again, kind of where that impact is going to have. So for the veteran community, a stock market in one way is going to be better for if you, let's say, have a 401k account. But again, this creates volatility in mortgage markets. And as the yields rise, lenders raise mortgage rates to keep up. Not only that, the cost of everything has gone up. So it's not just the 10-year Treasury. They also have different indexes that mortgage companies look at. And remember, one of the biggest things I'm always saying is that if you're seeing marketing out there, you are paying for that in some way. And typically that cost is passed on to you because just like any business or even at home, when you have your balance sheet or you have your net income and what your expenses are, you need to be able to make enough money to cover that. So all relevant to what's happening today and what potentially can happen in the future. So, with President Trump's re-election, we might see a return to economic policies that encourage growth and possible deregulation. These policies can increase consumer confidence and potentially strengthen the stock market, which, as we discussed, might lead to higher interest rates. And as the bond rate increases confidence in the economy, mortgage rates will also rise and follow. But again, there is a piece to this where they can step in and start purchasing those mortgage-backed securities. But I think a lot of people are hoping that that happens. This is the challenge. Right now, we have a lot of people that still have those really low interest rates that are not selling, right? So we kind of have a clog in the wheel, you can say. And right now, prices have gone up, and they've been going up, and rates have been going up. So why are people still buying at record numbers, right? They're basically gobbling up everything that they can. And I'll tell you that it's a couple things. Historically, values have gone up minus a couple times throughout history, especially if you take out 2008-ish when they had all those like basically ninja loans, right? No income, no asset loans. That were basically made up loans for primary properties. Those type of loans are completely gone now. Right now, people that are buying properties, they qualify with the income that they have. And just as a side note, remember, your VA disability income does count towards you being able to purchase a property. And furthermore, in certain states, and depending on what rating you have, you can also be eligible for property tax breaks, which also makes home ownership a lot more attainable, because there are a lot of places still today in this country that you can purchase a property and your monthly payment is going to be lower than a rental property. That's why you got to do a lot of research yourself so you can position yourself in a much better spot to be able to become a homeowner. So as we see the market right now, I am a huge fan of purchasing properties in November, December, and January because it is typically the slowest time of the year. And that's when I bought last year, was in December. I preach it all the time because it's true. You have normally a lot less competition, so you're able to get in. You have the potential of asking for credits because, again, it's normally a slow market. And this is where you can make some big power moves so you're not as competitive. And that's another side note to this. A lot of veterans will go into real estate thinking like, well, I don't want to be in a crazy competitive market. Guess what? For majority of people, that is going to be the case. And even let's say you're in a slow market, for whatever reason, anytime you're interested in a property, all of a sudden somebody else is interested in the property, then again, you're going to be going into this bidding war. And you want to be able to avoid that, I would say, as much as possible. And hopefully you maybe come across another veteran selling, maybe make the relationship a little bit stronger. But again, those are things that are happening in real time that open up opportunity for you to be a homeowner. And remember, if rates go down, and let's say they implement this policy where they say, hey, we're going to buy up all the mortgage-backed securities. We're going to drop, hypothetically, let's say they drop rates to 4%, right? All of a sudden, you're going to have a lot more people enter the housing market. What happens when more buyers enter the housing market and there's less inventory? Basically, home values go up. It's supply and demand. And I think a lot of people, again, are just sitting on the sidelines waiting for something to happen that I personally just don't foresee happening. If it was gonna happen, it definitely would have happened already. I think the last time we probably would have seen a major housing, let's say, reset would have been during COVID, but they stepped in, did the bonds, stock market did really well, so they avoided that. And in today's economy, you also have to factor in that we're going to see the largest transfer of wealth in the history of the world, with baby boomers passing away and their assets going to their children. I also read something here the other day because I was doing research for the video. About 40% of properties are paid off across the country. So they are sitting on a lot of income, you can say, or not income, you can say, but like a lot of equity in their property, unrealized capital gains, as they say. So there's, again, a lot of opportunity out there for people to become homeowners. I think the biggest thing for everyone out there is to focus in on your budget and your credit, because it's going to give you the best opportunity to purchase a property. So again, rates will go up. Let's say rates go down, home values go up. And in today's market, home values go up, even though the interest rates have been up. So make sure you guys hit the like and subscribe button to catch more content like this, because we're always sharing information about VA home loans, real estate, how you can better yourself and your future, no matter if you're looking now, 10 years, or 20 years from now. And remember, we always have battle buddies out there that are looking for information, and this is a great resource for them. So I'll catch you guys soon.